So I mentioned Morningstar when we were talking about mutual funds in chapter 4, right? The Morningstar is a very comprehensive source of mutual fund information, and Morningstar also assigns ratings to mutual funds. Those ratings are actually quite popular. Many fund companies actually report Morningstar ratings along with other fund information. So just to give you a quick example here, this is from T. Rowe Price. T. Rowe Price offers number of mutual funds. You can see here these are the highest rated funds from T. Rowe Price. So some have like a 4-star rating, some have like a 5-star rating, and so on, right? So these are Morningstar mutual fund ratings. So how exactly are these ratings determined? So we don't know exactly what is Morningstar's approach to determine these ratings. It is based on performance evaluation, and they do account for risk in performance evaluation. So their criteria, whatever they are using, is very similar to the Sharpe ratio. I mean, if you rank the funds based on Sharpe ratio, then you will find that that ranking is very highly correlated with the Morningstar ratings, right? But they're not exactly using Sharpe ratio, but using something similar to Sharpe ratio. So it's a proprietary approach that they use. So again, we don't know the exact details, but this is basically how it works. They rank the funds based on their past performance on a risk adjusted basis, and they group the funds into uh, rankings, right? Percentile rankings. So bottom 10% of the funds within a category, those would receive the 1-star rating. So these are the worst performers, and then the top 10% of the funds receive 5-star rating, and then you have these intermediate 2, 3, and 4-star ratings, right? So again, if you invest in mutual funds, you might come across Morningstar ratings for the funds, and this is where those ratings are coming from and what they mean. Okay. Now, as we have talked about earlier, performance evaluation techniques are not without problem. One of the problems is that the risk is continuously changing, and sometimes that is by choice, right? So you in your static type of metrics, you assume that the fund's risk is constant, but in reality active management is very dynamic, and the fund risk is continuously changing. That is hard to capture in your static metrics, right? So, and then of course there is the luck versus skill issue. We have talked about this before. Some funds might do well simply due to luck and not really due to skill, and so that is also an issue here. And then of course you have the survivorship bias, which I think talked about earlier as well. The worst performing funds might go out of business, and then what remains are the good performers. So if you just look at the performance of what is out there, it might be upward bias because you are not including the ones that are no longer out there due to failure in your sample, right? So that is survivorship bias, which sort of induces an upward bias in your performance evaluation. So those are some of the things to be aware of when doing performance evaluation. Okay. Next, I want to talk about performance attribution. And again, even though I'm going to sort of use an example here, my expectation from you is to just understand this attribution approach at a more intuitive conceptual level. You won't be responsible for doing any calculations with an example like the one that we are using here, right? So I'll use the example to illustrate the concepts here. So what exactly we mean by performance attribution, right? So let's say there is a mutual fund that earns a 12% return, right? It's an actively managed mutual fund, 12% return over the past year, and let's say over the past year its benchmark has a return of 10%. So fund earns a 12% return, benchmark has a 10% return. The fund was able to outperform the benchmark by 2%, And what we try to ascertain in performance attribution is what is the source of that extra 2% return. What is it that the fund actually was able to do well to generate that extra return? And again, we know broadly what are the sources of abnormal return, right? We have talked about this at the beginning of our discussion. A fund might be good at timing, for example, might be getting in and out of the markets or correct sort of asset classes at the right times, or the fund might be, or the fund manager might be good at picking securities, stocks or bonds or other securities which are part of the portfolio, or the fund manager might have industry expertise and is good at identifying the industries to allocate more money to and less money to and so on, right? So broadly speaking, it's the selection skill either for individual securities or for industries, or timing skill. And the goal of performance attribution is to attribute the performance to those different things, whether it is timing, whether it is selection, and if it is a combination of both, what percentage of superior return is coming from timing, what percent is coming from selection. And that is true for inferior performance as well. Okay, so here is an example of a balanced fund, right? So this is a balanced fund. Remember, balanced fund that includes both stocks and bonds. So this is a balanced fund that includes actively managed balanced fund that invests in both stocks and bonds. And because the fund invests in stocks and bonds, its benchmark against which it is compared is also a combination benchmark, right? It includes 60% in S&P 500 and 30% in bonds. Here it says Lehman Brothers Bond Index, which is no longer relevant. So you can think of like a Barclays, Bloomberg Bond Index, or other basically aggregate market index and so on, and then 10% in cash. These are the benchmark weights. This is the weight in the benchmark against which the fund's performance is going to be compared. Okay. This combination of indexes to create a benchmark portfolio, that portfolio is also known as the bogey portfolio. So in this case, our benchmark portfolio is made up of three indexes: S&P 500 index, which is the stock index, then we have a bond index, and we have a cash index based on some money market securities. Okay, so these are the appropriate weights that have been determined for the benchmark of that fund. Of course, the actual fund can deviate from these weights, right? So fund manager might choose to put more or less than 60% in stocks, more or less than 30% in bonds, and so on. Okay, now this is the return. So this is, we are doing this performance attribution for a particular month, right? And for that month, the S&P 500 earned 5.81%, the bond index earned 1.45, and the cash earned 0.48%, right? So take the weight and you multiply it by the return and add it up, just like you can see here, and that would give you the return on the benchmark, right? So 0.60 times the stock return or a stock index return, 0.30 times bond index return, 0.10 times the cash return. And so benchmark had a return of 3.97% over this month, and our portfolio actually earned 5.34%, right? And so what's the difference? 5.34 minus 3.97, 1.37%. So the fund was able to outperform the benchmark by 1.37%. And again, the question is, what is the source of this extra return, this superior performance? What is it that the fund manager was able to do well to earn this or to produce this extra return? Okay. So again, there are broadly speaking, two sources of superior performance. One is timing or allocation decisions, and the other one is selection, right? So we start with timing decisions or allocation decisions, right? So this is, you can see the actual weights in the fund, right? So again, remember, these are the benchmark weights, right? 60, 30, and 10, these are in the benchmark. The fund was actually 70% in stocks. So the fund manager decided to put extra 10% in stocks. Fund was only 7% in bonds compared to 30% in the benchmark. So significantly underweight in bonds, and fund had overweight in cash, right? So perhaps this fund manager believed that stocks are going to do better than bonds, and therefore fund manager decided to disproportionately put more money in stocks and relatively less amount in the bonds, right? And the question is, was that a good approach, right? Was that the right thing to do? Did it help the performance of the fund, right? So these two columns we have talked about. This is the extra weight in the stocks, right? 10%. This is the extra weight in the bonds. It is negative because it is underweight. So we are basically taking the difference of these two columns, 1 and 2, and that is what column 3 is, excess weight. Okay, now let's first think about allocation decision, right? So here we are focusing on this allocation here. Was it a good allocation or not? So suppose that was the only thing the fund did, right? Just put, instead of 60%, just put 70% in S&P 500. So here we are not focusing on selection. The fund did not invest in S&P 500. But let's say if we were to assume that the fund invested only in the indexes, right? The only thing that the fund deviated from the benchmark was in terms of the weights, right? So let's say instead of putting 60% in S&P 500, the fund decided to put 70%. If that was the case, so now we know S&P 500 return was 5.81 and the fund put extra 10% there. So you multiply 0.10 by 5.81 and that will tell you how much of the extra return of the fund is coming from that extra weight in S&P 500, right? And this is again assuming that, so for this top table, right, table A here, we are assuming that all that fund did was simply shifted the weights, right, and still investing in the index. So there is no selection here, it's all allocation. Okay, so you multiply the excess weight by the index return and then you add it up and you get about 0.31%, right? 31 basis points or 0.31%. So simply by shifting the weights, the fund would have earned an extra return of 0.31%. So that is due to the allocation decision. And we know that the fund actually earned extra 1.37%. So out of that, 0.31% is due to allocation. So that means the remaining 1.06% must be from selection, right? So then this bottom table here, table B, actually looks at the contribution of selection, right? So here we bring in the actual performance of the fund, right? Because now we are looking at the selected securities that the fund invested in, how well did they do, right, relative to the benchmark. So let's look at the equity part. The equity portion of this actively managed fund earned 7.28%. The benchmark had how much? 5.81% return, right? So the fund actually did a good job in picking the stocks, right? It picked the right stocks that allowed the fund to actually do better than the benchmark. What about fixed income? Same thing here, fixed income return was higher than the benchmark. So the fund actually did well in picking the fixed income securities as well, right? And of course the rest is cash, so there is no selection there. Okay, so what's the difference between these two? 7.28 minus 5.81, the equity portion of the portfolio earned extra 1.47%, and we know 70% of the fund's weight was in equity. So multiply the weight by that extra return and you get the contribution of that component. Similarly for the bonds, you multiply the portfolio weight by the extra return and you see the contribution of that component here in the last column, right? So 1.03% of that superior return, that extra return, is coming from stock selection. The fund manager did really good. So two things happened here, right? A fund actually earned a higher return from its selection of stocks, and fund was actually invested 70% in the stocks, right? So that was a higher allocation to stocks. So that actually was the big driver of this extra return. A 1.03% return was actually coming from that component. And even though the fund actually did quite well in picking the bonds, but because its allocation to bonds was so small, only 7%, that did not add that much, right? 0.44 times 0.07, so only 0.03% is due to fixed income selection, right? And overall selection is contributing 1.06%. So this is how we can break down this 1.37%. 0.31% is coming from allocation decisions, right? Deviating the weights from the benchmark, and 1.06 is coming from selection decision. Okay. So that is like a broad breakdown into allocation and selection decisions. We can look at this at the industry level too, right? So for that, we have to look at the industry weight. So this is again for the stock portion of the portfolio, right? These are the weights in S&P 500 for these various industries. These are the weights in the fund for those various industries. Let's focus on a couple of things here. Consumer non-cyclical. S&P 500 is about 20% in that month. This fund has 40% in consumer non-cyclical. So this fund has twice as much weight in this one particular sector compared to the benchmark. And it turns out that this was the best performing sector of the month. It earned an almost 10% return, not almost, but actually 10% return, right? So the fund actually had an extra 20% in consumer non-cyclical, which happened to be one of the best performing sectors for that particular month, right? So that is telling us that a large component of this superior performance that the fund was able to generate was because of its disproportionately high allocation to a good performing sector, right? You can see here almost 2% of the return was due to that extra allocation to consumer non-cyclical, and many other numbers are actually negative here, right? So this is how you can sort of ascertain the industry component or industry selection ability of the fund, right? So this is what we refer to as performance attribution. We're trying to attribute the performance to various components, so that way the fund managers can actually see what they did well, where they might need to make any improvements, some changes in strategies or modifications, things like that. This is just an overall summary of performance attribution exercise that we just did, right? So allocation part is 31 basis points, the rest is selection decision, and then overall the fund actually was able to earn an extra 1.37% return. Okay. So again, like I said, you do not need to worry about any calculations related to this performance attribution. Many of the softwares, financial softwares, Bloomberg and other softwares, they actually have inbuilt performance attribution. So you can just input your benchmark and the numbers for your portfolio, and the softwares can actually do the performance attribution exercise for you. All right, so last part here is a bit about market timing. Again, I don't want to discuss this in too much detail. Just give you some idea about market timing and how its performance has been, and how the performance could be if someone were to be successful at market timing. So again, what market timing means is if you think that next month the stocks are going to do better than bonds, you move your money more into stocks and away from bonds. If next month you think that if you think that stocks are going to underperform, you sell your stock positions and move into other assets, right? So you're basically trying to time the market, and if you're successful, of course, you will come out ahead, right? So you're shifting money between different types of assets. Okay. Now evidence suggests that investors actually have very little ability to time the market. I mean, those who actually engage in market timing, turns out that they do not do very well, right? So it seems like it is extremely challenging to time the market and figure out which asset classes are going to do well in near future. Okay. So I just want to actually show you an example here, just sort of an exercise, a thought process here that we are actually looking at, a thought experiment. So let's say somebody were to start in 1926, and 1926, because since 1926 is when we have the stock market data available for US, right? And so our time period that we are looking at here is 1926 to 2008. Okay. Uh, so let's say an investor puts $1 in cash. So here we're talking about treasury bills, right? $1 in treasury bills in 1926. How much does that end up with, right? How much does that $1 grow to by the end of 2008? So that would be $20. Okay. Let's say the investor starts with $1 in S&P 500, right? So this B category here, this is for S&P 500. $1 in S&P 500 in 1926 would have grown to 1626 by 2008. Okay, much higher today, since the stock market has gone up since 2008. All right. And what about a market timing strategy? So what is the market timing strategy? Each month, the investor is switching between cash and stocks, treasury bills and stocks. So if the investor believes that next month the stocks are going to do well, the investor puts 100% in stocks. If next month the investor believes the stocks are going to perform poorly, the investor moves all the money into treasury bills. So investor is basically switching between cash and stocks, right? And if, let's say, over this entire time period, the investor is able to do it successfully in every single month, right? Able to basically perfectly time the market. So this is what this perfect timing strategy is. In that perfect timing strategy, $1 would have grown to this amount here, right? This is actually very shocking to many people when they first see this. This is a 36 billion dollars, right? 36 plus billion dollars here, right? So $1 would have actually grown to more than 36 billion dollars in this perfect market timing strategy. Remember, this investor is skipping all the bad market returns, right? Skipping all the downturns and capturing all the upside, right? So that's what is leading to this outsized performance, right? So that is what market timing can do. But of course, we know that there aren't many billionaires out there, which tells us that market timing is actually extremely difficult. All right, so that was our little bit about market timing, just trying to illustrate how market timing can add to performance, but why, or at least the evidence suggests that it is actually quite difficult to do. All right, so that concludes our discussion from chapter 18. Our last chapter is on equity valuation that will begin next time.